Welcome back. Today we're continuing our series on federal student loans. We've covered a lot of things. We've covered income-driven plans. We've covered how to calculate your discretionary income. And today we're going to start with the section on marriage and student loans. How do they affect your payments? How are they affected in death and divorce and private loans and federal loans? So hopefully today we can provide some insight into how these things will work in your situation. Let's get started. Today in the first video on the marriage part, we're going to focus on how these payment plans, the income-driven plans that we've talked about, are affected by your marriage. So today specifically, we want to talk about how that affects your payment when it comes to the income-based repayment plan, the revised pay-as-you-earn, and the pay-as-you-earn. And to do this, to tell you the differences, it will be helpful if I give you an idea of what I typically see. So again, this is not a recommendation, but typically I have to lump these two into groups when it comes to marriage, because the income-based repayment plan and the pay-as-you-earn plan are things that I typically see used for couples where only one in that relationship has significant student loans and the other spouse has little to no student loans at all. Now, revised pay-as-you-earn, conversely, is typically seen by me for couples who both have significant student loan debts. And why is that? Well, if you lump the first two together, the income-based repayment plan and the pay-as-you-earn plan, those two plans allow you to manipulate whose income is considered in the calculation for your payment each month, whereas the revised pay-as-you-earn considers both of your incomes no matter what. So we'll talk about how that plays into the choice that you make for your payment plan, but I do want to put those two separate groups together, and we'll start with the first two, income-based repayment, pay-as-you-earn, because we want to tell you how you can only use your income if that's appropriate, and how that affects your payment plan if your spouse is having his income or her income included in that payment. So on the first two, to recap a little bit, backtrack, we'll reference something that we talked about in the first videos. So the three income-driven plans that we've been referring to, all of them ask you to pay a percentage of your discretionary income each month towards your loans. And that typically is 10 to 15% based on the plan that you have, and 20 to 25 years is how long you have to pay, again, based on the type of plan that you're under. So when you look at the formula for calculating that discretionary income, if you recall, it is your salary, your household salary, minus 150% of the federal poverty line for the number of people in your household. So common sense will tell you that if you have more salary, if you have your spouse's salary included in that calculation, your payment's going to be higher because your discretionary income is going to be higher. So first we'll tell you how you can avoid having their income included, and then we'll get to whether or not it's worth doing because of the consequences that come with that strategy. First, how do you avoid having it done? Well, the first way is you can talk to your student loan servicer, and every year when they send you the application to reapply and recalculate your payment for these plans, they may have something on their application that will allow you to say that you don't have access to your spouse's income information. You may not have a tax return. They may be a partner at a business and they get a draw, and it's not clear until after you file the end of the year taxes what they actually got paid. And if that is the case, you can file that you don't have access to that information, and they won't include it when they do your calculation. But you still get the benefit of having them as a person in your household when it comes to the federal poverty line. So the benefit is the more people that are in your house, the higher the federal poverty line is. So in this situation, you get the lower salary, only using yours, but you get the benefit of having them in the household for your discretionary income calculation. Now, again, this is the honor system, so I wouldn't get in the habit of lying to your student loan servicers. This is truly for people who do not have access to their spouse's payment information. The second way is you can file your taxes married filing separately. Now, I am not a CPA, I'm not a tax professional, and I would encourage you to, if you're even considering this technique, to do it under the guise, not under the guise, but under the management, I should say, of a tax professional. But basically, you can file taxes a number of ways in our country. And for married couples, two of those ways are married filing jointly, which can be a little more forgiving in terms of the tax ramifications for married couples, Or you can file married filing separately. So you file your returns. It doesn't have anything to do with your spouse's information. Now, again, the reason that you want to do a tax professional or work with a tax professional for this is because there are a number of things you need to know before you file your taxes separately. There are deductions that you might not qualify for. You could potentially expose yourself to higher income taxes. But when it comes to your student loan payment plans, filing separately means that only your income would be included in that calculation. So while on the one hand, that would be good for your student loan payment, you would want to work with that CPA or that tax preparer and have them run a scenario that basically says, am I reducing my loan payment but costing myself more in taxes, and find that break even? Basically, am I saving myself $100 a month on my student loan payment by not including my spouse's pay, but I'm costing myself $200 a month in increased taxes by taking out this strategy? So if you can't find those calculations, if you can't find that break even, then you probably don't want to be doing this on your own. You want to make sure you have someone helping you along the way, but it is a way to possibly lower that student loan payment. Because of this, you can start to see why people who only have one spouse in that relationship that has student loan debts would be gravitating towards these plans. Because if my spouse doesn't have loans, then why would I want their income included when I can potentially find a way to have that lower payment just based off of my income? If they don't have a payment of their own and it's just mine that we're considering, then this is something that might work out for you. But again, it's no guarantee, and you want to work with a professional to figure it out. Now on to the second group. The revised pay-as-you-earn plan sits alone in the second group. And the reason for that is because no matter how you file your taxes, no matter whether you like your spouse, know what they're getting paid, they are going to include both incomes in the payment for your discretionary income calculation under the revised pay-as-you-earn. And because of this, I see this most often with spouses who both have significant student loan debts. And as we go through the details, it'll make sense why. If you think about it this way, let's say that I have a ton of student loan debts and my wife has a smaller amount. Well, her smaller amount probably could be paid off under a standard repayment plan, a 10-year plan, a 15-year plan, and what have you, because it's likely that she makes enough and can pay enough to pay off those loans in full. So if that were the case, me doing an income-based or income-driven plan that asks for 10% of our household income might not work out, because then we would have her standard payment plan and 10% of our income going towards my plan. So it just puts you in a situation where you're paying more than you might typically need to. But if both of us have significant debts, then it's likely that both of us were going to be gravitating towards an income-driven plan anyways. So the revised pay-as-you-earn plan makes sure that they take steps to ensure that both of your loans are considered and that you don't exceed 10% of that discretionary income when you have both of your loans in the same pot. Now, when I say the same pot, I don't mean that actually you go from 2 loans to 1 loan. You will always have separate loans. But what the revised pay-as-you-earn plan does is they take the balances that you owe, they put them into one, not literal pot, but they put them together, and they assign a percentage based on the amount of debt that each of you brought to the table. So, for example, if we owe $200,000 combined, and 75% of those loans are my loans and 25% are hers, then they're going to make sure that we have a monthly payment that doesn't exceed 10% of our income, but that monthly payment will make sure that 75% of the payment goes towards my loans and 25% goes towards my wife's loans. That's how they make sure that even though your loans aren't in one pot, that your payment is going towards the right places and is going in a proportionate amount to what each of you brought to the table. Now that we've talked about how to go about having your spouse's income included or excluded, it is important that we talk about what if both of us make just a large amount of money? How does that affect these student loan payments? And again, we have to go back to the groups to explain this. See, the first two that we went over, the income-based repayment plan and the pay-as-you-earn plan, they put caps on the amount that you owe, meaning that even though those calculations are supposed to say that you pay 10 or 15% of your discretionary income, under these two plans, if that payment means that you're exceeding what you would pay under a 10-year repayment plan, then they do not make you do your discretionary income. So for example, if you find out that you could have paid $1,500 a month and paid off your loans within 10 years under a standard plan, but when they do the discretionary income calculation, then your payment would have been $1,800 a month. They're not going to make you pay the 18. You would pay the lower amount and go to a typical standard 10-year repayment plan. But under the revised pay-as-you-earn, there are no caps. So even if you and your spouse make $1 million combined, whatever that calculation says your discretionary income is, you will have to pay 10% of that amount, no matter how quickly or how fast it would have made you pay off your loans under a standard plan. Again, that is why you typically see spouses who have both carry significant student debts going toward the revised pay-as-you-earn plan, because it's unlikely until they get to just a very large amount of income that their discretionary income would have had them paying off their loans faster than under a 10-year plan. That's it for today. We've covered a lot of information, and typically we focused on how it affects your payments. So in part 2, or part B of this series, because we're in the middle of a series, we're going to cover things like what's affected by my student loans in terms of death. If I go to a private loan, how does that affect my student loans and my spouse? And we'll finish up on the marriage part, and then we'll finalize the series in the next couple videos. So I know it's a lot, but it's a lot of information, and it's important to a lot of people out there. So again, if you like what you heard, please share it with as many people as you can. We want to help as many people as we can. And if you have a topic that you want considered for a future video, you can submit it by going to my website, www.brentonharrison.com. And under the blog section, you can click the questionnaire and fill it out for topics you want to be considered in the future. Hope you guys tune in next time, and I'll see you then.